This podcast is for informational purposes only and is not provided as financial, legal, or any other advice. The information is not investment advice or an offer to buy or sell any securities or make an investment. The views expressed by guest speakers are their own, and any reference to third-party products, services, or information does not constitute an endorsement thereof by SNN or its affiliates. SNN expressly disclaims all liability for any individual's use of the information presented in this podcast. My guest on the show today is Sean Black, CEO of Happy Belly Food Group. It's a publicly traded company. I got a couple symbols for you. HBFG on the CSE and HBFGF on the OTCQB. Happy Belly is a Canadian consolidator of emerging quick-serve restaurant brands with expansion plans into the U.S. The company started as Plantingco, a niche plant-based CPG business, but under Sean's leadership pivoted to become food agnostic, focused on scalable, cash flow positive QSR concepts. The model is straightforward. Acquire small, profitable, debt-free brands, grow corporate stores with free cash flow, and scale through franchising. The portfolio is intentionally diversified with no duplication. Think Rosie's Burgers as a Shake Shack equivalent, IQ Foods as Canada's Sweet Greens, and Pyro as Cava-style concept. I spoke with Sean because I really wanted to learn more about the company as well as the pivot from Plantingco to the QSR consolidation, their M&A model and brand strategy, growth targets, and the $100 million Canadian milestone, as Sean states, as well as risks, alignment, and long-term vision. With that, please enjoy my conversation with Sean Black, CEO of Happy Belly Food Group. Sean, thank you for joining me today. How you doing, man?
Thank you very much for having me. Doing great. You know what? It's sunny and nice day here in the GTA.
Oh, there you go. Awesome. Being from the lower 50, I wish I knew what GTA was. I'm sure.
Yeah, well, Greater Toronto area.
I was going to say, I should probably know this, being that we're about to do this event in Toronto. So I'm sure I will find out.
You'll find out, and you're coming at a good time, right before it gets unenjoyable and cold.
Oh, there you go. Well, hopefully it'll stay that way for the entirety of that week, at least,
100%.
But, look, I've known about the company for a while. I've been following some of the news and updates, and, I've been seeing some of the stuff out there. So wanted to invite you on to get a better understanding of Happy Belly and the full picture, the full story, just really want to get the full story, what's going on.
Absolutely.
So the first question that I ask everybody on this series here, and I'm not going to ask you the same thing, is can you give us that one line that best describes the company?
Absolutely. We are a consolidator of emerging food brands. So if you look across Canada, that's what we do. Anything that is growth oriented in food, that's the space we play in, specifically QSR. So typically quick serve restaurants.
Very good. Lot to dig in there. But first, let's look back at the company's history. When was the company originally founded, and what was the original thesis for its founding?
Originally, the company was founded as Plantingco, so it was a plant-based focused food business. When I joined, we quickly realized that although the market was growing in plant-based, it was still pretty niche. So to be a player and become a company at scale, we believe that we need to be agnostic to the food business. So we opened it up, not just CPG, but to QSR, and we opened it up to plant and non-plant type businesses. Today we have 2 in the QSR side that are plant-based, and we have 8 that are not. So that's where our focus is and where the growth is really coming from in the company. We've went from all the way from starting with plant to now serving some of I believe the best burgers in the country. So
yeah, that's a trajectory, right? Going from just totally plant-based to now burgers. There we go.
Canadian beef. So.
There you go. So, you kind of caught us up to there, but what were some of what gives kind of the full picture of where we're currently at today? How many restaurants are within the portfolio? What's some of the trajectory where you're looking at? So let's go from there.
Today we have 2 CPG brands. Good news is both of them are cash flow positive and debt free, but they're a small piece of our business today. They used to be a significant piece of the business, probably more than 50% of our revenue at the start was CPG, and today if you look at it, it's sub 15%. And as we're going on system sales, it's sub 2%. As an overall, the focus shifted to QSR. which is my background. Started in the restaurant business when I was 14, opened my first one when I was 19, and started scaling it. So to give you an idea, when I joined, the business was doing about 250,000 a quarter in revenue, so about $1 million a year. On a system sales basis, we just finished last quarter, which was our 13th record quarter in a row. We were just over 16 million in system sales, and we have a clear path to 100 million a year in system sales with our current pipeline in the short term.
Very good. We will touch on all that in a little bit later, but want to also better understand the company's business model. Obviously, there's a clear, hybrid of, organic growth as well as looking at various acquisitions. So love to hear more about what you would say is the main business model for hitting some of those or those revenue targets that you're looking at, and then also maybe some of the criteria for those acquisitions too.
Absolutely. So we started off, not long after, I'm going to say probably about 6 months after I joined, we probably announced our first, we did some cleanup, and then we announced our first M&A deal. Again, it was a profitable business, debt-free, cash flow positive, and that's sort of the space we like to play. Find something small in the food space that we can ideally, we'd like to double the EBITDA on that asset within 24 months or less. And we did that first on a CPG brand called Lumberheads Popcorn. Then we did it with a small QSR brand called Heal Wellness, an acai bowl chain based out of Hamilton. They had 2 stores. We're a little bit profitable, but it needed some work. And today that brand is 27 stores open, and it'll be north of 30 by the end of the year. On track to be north of 100 stores open within 24 months, and north of 100 million in system sales just on that brand. So, from a brand that was doing about 1.4 million when we found it, we will have, in short order, have 100x the revenue on it. So, it took time. It wasn't an overnight success story by any means. We've been working on that brand for just over 3 years. So for, it'll be a, 5-year run rate to get it from, from not from scratch, but from first base all the way to home plate. The good news about that brand as well is it is debt-free, cash flow positive, and growing. So, that's sort of where we first started, and we really found our niche in the QSR space. So we've accelerated on the QSR. That was our first one. Today we have 10 QSR brands. We're about 75 restaurants open across Canada. We have, I believe, 626 stores total in our pipeline across Canada, and 10 in Texas so far. That's part of that pipeline. We're looking at that as our first test market. Hopefully in early 26, you'll see us start to open stores. But in early 26, we're looking to be 100 stores open, $100 million run rate on our system sales, debt-free, and just scaling our business.
So let me ask you this. I mean, how are you balancing the clear goal of moving fast? Really fast. I was joking with you line a minute ago. Like there's, you have a new press release every freaking day of a new QSR or so. You're like, oh my gosh, like I barely finished the last press release. You already got 4 more in the next 3 days. Jeez Louise. Like how are you balancing the just moving that quickly and hitting those revenue goals with also, all right, this fits our criteria? Is there just really that many opportunities right now that you're like, all right, we just got to move that quickly? And because we're moving that quickly, is that we can hit this?
Well, that's a good question. And, a big part of that is because we have 10 brands, our goal was always to, get to the point where we could open 30 to 50 restaurants a year. And now if we only had one brand, that would be a lot of pressure on that one brand, because you'd have to deliver 30 to 50 stores out of it. And
totally.
In my opinion, that would be, I believe then you have to start compromising. You have to either compromise on a franchisee or compromise on real estate or anything. If you're just trying to be just in Canada, open 50 a year, that's impressive. So from my standpoint, what we wanted to do was get to 10. And then if every brand, delivers 3 to 5 in a year, well, then that's so much easier. So, we were very lucky to work with Fairfax and Recipe previously. And if you look at them from a growth standpoint, they're really, really disciplined. And they were previous partners of mine when we owned 2 other brands. And their operating discipline was something that I believe pays, spades for us today. The dividends are great off of that. So we look to diversify our risk and diversify the growth across a multiple brand portfolio, which makes it easier for us to access real estate, easier for us to access franchisees, and still deliver on a combined basis a significant growth number across the company. Now, some of that growth of the say 30 to 50 stores, two of your brands might deliver that many on its own, but you don't have to. And if you do deliver more across the entire portfolio, then you can probably surprise to the upside and open more stores than you originally anticipated.
For sure. And when you're thinking about, having, and engaging with different potential store concepts, different QSRs, are you careful to think about like, all right, we already have Rosie's Burgers. Can't have another burgers place. Like, I mean,
that's watch guys 100%. Watch guys go before us, and they had a lot of duplication in their portfolio, and I believe that's really tough because it's like having, twins and then deciding which one gets something. Like it's really hard. So what we like to do is keep the portfolio diversified and only have no duplication. So if we're going to have a burger brand, we're only going to have one. And if ideally what we're going to do a little bit differently than some of the other guys down the road is if we go do another burger brand, ideally what we're going to do with that brand is do what basically in the United States what Cava did. Cava went and bought Zoe's Kitchen. Cava was 60 stores. I believe Zoe's about 300. And they started to convert them. And then they got that lift and that arbitrage between what Cava did in sales versus what a Zoe's did. So I'd love to find another underperforming burger brand and then convert them to Rosie's and get the lift and the arbitrage on the asset. That's what we look to do. That way we don't have to have duplication when it comes to real estate or franchisees or anything. If you want a bowl brand, like, we built a portfolio of basically, you're in the US, you'll appreciate it, but whatever's really, really growing and popular in the United States, we went and basically got the Canadian version of it and put it into growth mode. So we have our answer, Small Tiger is our answer to Dutch Brothers. If you look at Sweet Green, we have IQ Foods. If you look at Cava, we have Pyro. If you look at Shake Shack, we have Rosie. So really clearly identified categories that we believe have significant legs for growth in our portfolio.
Absolutely. And then another question I have, and this is just to clear it up. So I apologize for those who maybe know the story much better than I do. So I apologize, but I'm going to ask just to clear it up. On the actual business model side, is you're acquiring the concept itself and then just franchising it out versus owning the stores themselves? Or is it a mix of both?
A little bit of mix of both. We're a little more like the McDonald's model, where we like to reuse our free cash flow to accelerate corporate stores, and reusing the royalties and the money that comes in, so you get accelerated growth on the franchising side.
Got it.
But using a disciplined model on the cash flow to, we treat every day like if you only have $1 to spend, where am I going to get the highest rate of return on my capital? And so we identify the brands in our portfolio and we put free cash flow towards those brands, accelerating corporate store growth. So we'd like to, over time, ideally be about 10% of our stores will be corporate, and 90% franchise.
So, I mean, I know you love all your brands equally, so I don't want you to pick a favorite necessarily. I'm sure you have your favorite taste and then your favorite, they just the cash cow. But, I mean, for you, what's been the most successful one thus far that you've been kind of able to use, like flying the flag? Like, look, what we're doing, our concept is working. So it allows you to maybe go out to additional investors, raise more capital so that you can do more equity raises to go out and purchase more concepts.
That's right. So we're very lucky that we've got a few strategic backers on the fund and the institutional side that have backed us since early. But every time we've raised capital, it's been above market. We've never actually done a below market financing along the way. Today, the first one that we did a deal with 2 stores that's now 27 stores is Heal Wellness, our acai bowl chain. It's going to quickly be at 60 stores, and I believe we have about 190 of them sold. So it'll quickly be a 100 store brand, probably $100 million in revenue. We have in short order. So that's probably been the first one out of the gates, and I kind of say like it's the first one to leave the nest of our portfolio of emerging brands. Heal was first. I'd say a second one out of the gates that's growing and is delivering an incredible business model, unit economic model is Rosie's on the burger side. When we did the deal with them, there was 2 stores. There's now 8. It'll be in 2026 somewhere between probably 20 and 30 stores open. So that brand is likely to triple in size over the next 12 to 18 months, which is, impressive growth across the board for us. So that's in motion. The next one that is, we did a deal when it was 4 stores. There's now 6 and number 7 opening shortly, and that's IQ Foods, which is our answer to Sweet Greens in the United States. The difference from us and Sweet Greens is our asset is cash flow positive and debt free. And accelerating the free cash flow where, I think Sweet Greens has been, they've been 25-30 million a quarter of losses off their model. We typically run a much more disciplined, profitable model, with our book.
That's probably my fault. I stopped eating Sweet Greens a while ago. That's
you know what? I still like it. I go there.
It's fun. It works.
Yeah, I was in Dallas recently and I went and tried it. I went to one of the stores and I was shocked at how big it was and how few people were in it. But because then I've been to one in Florida. The staff are nice, people are nice, but I didn't find them as packed as I would have thought.
For sure. Nah, and I kid. I've had Sweet Greens, not that. Anyways, so real quick, want to hit on the CPG side because it seems clear. Look, I joke again about the pressure. Every single one's been on the QSR side. Not as much on the CPG side. So can you cover a little bit more about what's going on with the name of the brand is Holy Crap. I'm not trying to make a judgment of Holy Crap, but one of the brands is Holy Crap as well as the brand Lumberheads.
Yeah, that was the Holy Crap was one of the 2 OG assets that were legacy assets that were in the portfolio. And we kept it because we turned it cash flow positive and debt free. So, it's still a contributor to our business. That whole business was on, Dragon's Den and, our version of Shark Tank in Canada and stuff like that a while ago. It's a cereal-based business that based on super seeds, and it's meant for the microbiome. So it's meant for healthy stomach, healthy gut health, and that's where the Holy Crap comes from, the name. But it's one of those assets in our portfolio that we're okay buying more profitable CPG businesses, and we're also, somebody came along and wanted to really buy one of our brands because it's profitable, it's cash flow positive, we'd be okay selling that asset. So we're not. We're agnostic to the business as well. We love them all, but any one of our individual assets could be purchased or sold anywhere along the way. But CPG is a small portion of our business, but I like it. I actually eat the cereal often, and I'm a customer of our popcorn brand. So you know what? I did the belly check on both of them, and I liked them both.
Very good. That's what counts the most, right?
Yeah.
Real quick on the barriers to entry, this is seems like a fairly obvious question. Like, there's clear capital constraints, so not everybody can just jump in and do this. But, there are some folks with deeper pockets. I'm sure it's no, I guess you'd say mystery that, that some of these are mom and pop stores that, might be looking for either an exit or new path, so to speak. Right. So what's stopping somebody who has also deeper pockets and good institutional backing that also has a potential rock star CEO moving as fast as possible, competing with Happy Belly to go out and get some of these other brands to build up a portfolio like this?
What's stopping them? If they have the people, capital, like the means to do it, so that nothing's stopping them. Really, there's nothing. Just like someone else can open up another restaurant brand, which one shareholders like and which trust and believe in, and building that trust. I believe is one of the hardest things in the microcap world. To build trust with shareholders. I think it should be earned. First off, I don't think it should be just given. I think it should be the show me world. More people should look at the financials and look at the business and look at the track record, and they should look at as well, like, does the actions of the company match their words, right? Because I think there's so often that does not happen. So the good thing is, if somebody else wants to try it, we are 3 years of record growth, 13 record quarters in a row. We have the money. We've already done it. So, first off, someone else wanted to try it, I'd be the first one to tell them, please do. Like, why not try it? You know what I mean? Like, I'm not the only person that's ever going to do this in the world. Right now, though, we're one of the few liquid companies in the country that are consolidating. So we have access to sellers, we have access to investors, and I believe the open ice, down there, a little bit of hockey, but Wayne Gretzky's line of go where the puck's going, not where it was, and if
Right.
you can start to get that, I believe where the growth is today in the emerging brand sector in the country, I don't believe there's another food company doing what we're doing. So I believe, there's an incredible amount of open ice. I think that when I read a while ago, there was over 400 independently owned restaurant chains in Canada.
Mhm.
So when you talk about consolidating, like we can do this for a long time and compound our growth.
Absolutely. So has there been a restaurant concept that you were bidding on and just like, man, we really wanted that one and either lost out on it or they just, maybe got cold feet, something like that. I mean, you can name the name if you want to, but I was just curious if because again, you've been moving very quickly and
Yeah,
you can tell these guys, right? Look, like here, we're signing new, franchisees left and right. Like if you want to build the brand, like here we go. So I was just
yeah.
curious.
100%. Well, two things that even with a seller, you got to build some trust, right? Like,
Sure.
because you're taking a lot of them, you're taking their baby, or you're partnering and becoming a JV partner. But yeah, so you got to build some trust. That takes time. So a lot of times you invest a lot of time in a deal, and it just never materializes. You don't get them across the finish line. Probably one of every, I don't know, 10 or 20 you look at could you ever get a deal done. And usually it doesn't work because of the math. I mean, usually that you can, when money's involved, people will usually figure a way to get along. But sometimes it's just the deals, and we've been stuck on being really disciplined. Like I've probably been a pain in the ass to a lot of people over the years because I won't budge on certain things, and because I believe it's right. And the problem, like there's one of the guys that went in front of us and was pretty big, and they built their share price from one point from 10 cents a share to I think 74.50 on the TSX, which was the company I used to work at. I was the chief development officer at a public company called MTY. They've been one of the most acquisitive consolidator of QSR brands, I think in the history of North America. They've done a great job. But up till a period of time, that I think up until 2019, that stock was, one of the best performers in the history of the TSX. So if you look at us, you look at what made them great early on, it was their discipline and their M&A. So take a page from their book, stay really disciplined up till 2019, and it paid incredible dividends for their shareholders. So, yeah, we've had some deals that you just get to the finish line, and usually one of the two things happens. Emotions get involved. I mean, whether it's the buyer or the seller, and one wants more or one wants to pay less, or and then remember the other thing, it's either emotions or it's numbers. Usually, you get to the point when you do your due diligence, and something doesn't check out, and then that requires a repricing either up or down, and that's usually when emotions come in. So probably had 10 deals that were really close over the last 24 months that we didn't, for one reason or another, just didn't get done. A couple of them I look back and said, thank God. You know what I mean? Like, thank God.
I'm
Because
sure.
yeah,
Yeah.
like,
Yeah. Yeah.
doesn't matter whether it's tariffs come in or, supply chain on an issue or, the brand just shifted and you're thinking, thank goodness I didn't buy it. There's probably one that got away early on. And I probably look back and say, yeah, the founder would have been a bit of a pain in the ass, but it would have been a great business to own part of because I've watched it now take off. So we identified it early. We knew it was right, but for one reason or another, just couldn't get it, couldn't put the puck in the net and get the deal done across the finish line and across the goal line. But so yeah, probably in my career, I could think of one that I'm annoyed that I didn't get done. But of that, there's probably 10 that I've walked away on for one reason or another. Because that old line, like you can't do a good business deal with bad people. Sometimes you just for one reason or you can't get done, and it wasn't the right fit. I'm probably luckier that I locked away than the money I would have made off the one that I'm annoyed at myself for not getting done.
I'll have to ask you over a beer which one that was for
Yeah,
sure.
and sometimes it happens where the
Yeah.
sacrifice, the price of admission was just too much. Like I would have had to blow up my cap table. I would have had to, take on debt, or I would have had to do something that would make me uncomfortable. And when our team looked at it, we just said, no, we can't do that. You know what I mean? And so that operating discipline, like, hey, the odd time it might cost you, but I guarantee you over time, it saves us a lot.
This hits on another question I wanted to ask you. How do you tend to structure these deals? Is it all cash, cash and stock? I'd love to hear that.
We've done both, actually. We've done cash deals, we've done stock deals. A lot of times I prefer to do a deal where if you borrow a page from Fairfax, you buy, for us, typically we buy 50%. With a closed end transaction on the remaining 50. So we have the exclusive rights in 3, 4, 5 years to buy the remainder and become the sole owner of the business. So I love doing deals like that. That's been a real sweet spot for us. Allows us to get in, become partners, get a peek under the hood, operate the business. And what I find is that takes a lot of execution risk away from our M&A because we're already engaged in the business. We help with the accounting. We know the business inside and out. So and you can prepare for it. A lot of times when you buy a business, you're going in like the history of the business and that, but you've never ran it, right? So I mean, there's still some executional risk in there. You're not going in blind, but you're not going in like a partner that's been in the business for 3, 4, 5 years. So I believe it de-risks significantly for us and our shareholders to be a partner first and then buy the rest later.
Absolutely. So I'm going to ask a little devil's advocate question here. And I wanted to address, you mentioned it was 13 consecutive quarters of revenue growth, and you can correct my numbers if I'm seeing them here correctly, but for 2024, company did about just over 9 million Canadian, right?
Yep.
All right. So, and then on free cash was just over 900,000 Canadian or loss of 900,000 Canadian. Sorry.
Yep.
So what would you say, what's the break even number? What are we doing to continue to work towards?
Yeah, I think last quarter, let's say you burned $200,000-$300,000 because you're still investing in some stuff and you're going forward. Sure. And we did about 16 million in system sales. Our goal in the short term is to get us to $100 million in system sales, and be cash flow positive. So whether that's 1 quarter away, 2 quarters away, I mean it's in the near term, and we believe that we will turn that top line. We'll have that kind of trickle down effect to put us to the cash flow positive side, and then still have another 500 plus stores in the pipeline that if you average out at $1 million a store on average, you got another 500 million in system sales coming. So because there's if we want to do them all franchise, there's no capex required. We're lucky we still have several $1 million in the bank. We only have $150,000 today of secured debt across the company, so we're in a very healthy situation. And we have access to capital. So I like it, because if you look where it started, I think before I started, there was huge, back then promo money being spent, and there was, losses were probably, I don't know, I'm going to say $500,000 or $1 million a quarter. I mean, it was massive. And here we are today, about to flip cash flow positive and, be a long-term compounder.
Absolutely. So my next question is then also on the franchisee side. Sorry, I'm bouncing around. I got a million different.
Yeah, hey, I'm bouncing. Fire away.
So on the franchisee side, I mean, what's that pipeline look like for each of the brands? How are you engaging with potential? Is it mostly incoming, or are you doing any kind of outbound, seeing folks the interest? Love to know.
Yeah, you know what? A lot of our franchisees so far have been from our previous brands, and come and join us again on the next journey because they made money and did well early. Thankfully, we have a history in this business and a track record of opening successful brands. So attracting quality or qualified franchisees has not been an issue for us. And they don't all buy them because I'm cuter, and that's not the case. They buy them because we have what I call the best unit economic model in the business, and we provide a better return on invested capital than some of the other brands do. So that's what's attracting the quality. That's today we have, I think this year our goal was to open 30 to 50 restaurants. We'll deliver on that. Next year, our goal is to deliver 30 to 50 restaurants. Very confident we can deliver on that. And I think a majority of those restaurants that will open will come from existing franchisees opening second stores, third stores. One of our franchisees is on store number, I think 13, but they've purchased 30. So they've got another 17 to open just themselves. So that's we're very fortunate that one of our franchisees has opened 3. He's bought 16. So, there's a lot that, are still in our pipeline to be opened by our existing group. So we don't do franchise shows today. We're not out there spending a bunch of money on social media to generate online advertising. It's not what we're doing. We're doing it through the belly and through, I should say, social media and through the belly versus that. But we're not doing like online advertising.
Absolutely. So here's a question that I love asking every CEO on here. You public company, you put out your releases, Qs, Ks,
Yeah.
all that. You've done a little bit of the dog and pony show. We're probably met investors, institutions, whatnot.
Yep.
What would you say for those that have an understanding of the business? They know they get it, they understand, but there's like, but I'm still confused or about this one or two things. What are some of those frequently asked questions that maybe you still get from investors that maybe we haven't even covered yet?
I think a lot of them say like one of the biggest comparables out there in the market that people use is some of the big popular brands that have grown in the US to see valuation stuff like that. But in Canada, typically people compare us to MTY, my former company where I worked. Is because like what are the chances you could be that next one or the next success story like that, or why would I invest in you over them? And like that's a direct question that I often get. And for us it's investing in the management, investing in the brands, right? Then the people. So it's a people business. The three P's: people, product, and process. So if you like our people and like our product, that's the one that's out there. But typically the biggest comparables out there are, what people ask, say, what's your, how do you compare to them? What's your valuation? And what's the growth outlook like? And if we maintain that we are the leading consolidator and leading growth company in QSR in Canada over the next 2-3 years, I think, considering to my point earlier of 13 record quarters in a row, I think our franchise stores are going to do well. Our corporate stores are going to do well. Our staff will do well. And if those things get taken care of, then usually, in my opinion, the share price and the shareholders do well also.
Absolutely. Another favorite question I like to ask on here, and it's another devil's advocate type question, and you probably get this all the time. But in your opinion, what would you say are some of the company's downside risks?
I got asked this one the other day.
I was going to say, other than execution risk, of course.
Number one,
that's the obvious one. Yeah.
Key management. I don't know, someone getting hit by a bus. That's a real risk. You know what I mean? In any microcap or any small company, the saying, you're only as good as your management. And they're even more dependent on management as a small company than probably a bigger one is got a few people that could do it, and a big army of a team. So I think people is probably the biggest risk to that. I recently we lost our CFO. He had passed away. A real battle with cancer, and
I'm so sorry for your loss.
Yeah, no, but it's the first time that something has ever happened to me personally, and it was brutal. He's one of the nicest people I've ever met. I never met a CFO, first off, that smiles every day. Like, he smiled more than anybody I know, which is strange for people that are in the accounting world. I don't always see that. So that's through all that you learn that's probably the biggest risk is people. So what if somebody, if a successful CEO leaves, if a successful team member passes away, those are risks. And today we announced a new VP finance that joined us. Josh, he came from a TSX company. He's got experience, and so we have continued to add to the bench so that as we grow, I believe the people portion of it becomes the de-risk more for shareholders. But I still believe that's the number one risk in a company today. We have lots of money in the bank. We're growing. We're okay. When they talk about execution, the biggest risk I could have taken in on the business side would have been do a massive M&A that brought in either ridiculous dilution or wasn't profitable when it came in, and it came with debt, right? So if you ever want to blow up a microcap, I would say take on a lot of debt and put the knife right to your throat. You know what I mean? Like, where you can't tread water fast enough because the bricks on your feet are pulling you down. I think a lot of companies they try and just buy sales. They don't buy profit, right? And I think there's a real risk in any business of running out of money.
100%. The two other risks that I was also thinking about, and I'd love to hear how you address them, is having to do with consumer preference shifts, right? Going towards healthier eating, even maybe
Yeah.
just staying at home cooking, that kind of stuff, as well as economic conditions. I mean, I'm in LA. I can tell you, unfortunately, a whole bunch of mom and pops that shut down just because it's so expensive to hire, the people that you need to actually run the
Yeah.
industry. So,
I looked at an M&A deal previously in California, backed by a very wealthy family, and it was on the plant side. So twofold, I felt that was under pressure, the plant side, and I also felt California with the recent labor changes and stuff like that were unfavorable. So that's why I passed on it. They had restaurants in California and Nevada. The deal was brought to me from a friendly source. I just couldn't do it, even though they were willing to back it, do everything, support us. Like they're willing to do whatever I want, we don't want it to get the deal done. I just couldn't do it. The risks on that M&A deal were not favorable, so we passed. But we're very fortunate that we have a diversified portfolio of brands. So we have the healthy side to like IQ Foods, Heal Wellness. We have a plant-based brand called Let Us Love, to the burger side, and to a breakfast brand that that is more on the indulgent side, and they've got sweet treats and stuff like that called Yolks out of Vancouver. So we have both sides of the spectrum. So we got a diversified portfolio in the mix. So healthy, not healthy, price points are different. Also to the point of our geography. So we have stores now that are going to be open from Vancouver Island all the way up to PEI. So literally coast to coast. So if we were one single brand and concentrated on the market, like that one brand that was almost all of its restaurants were in LA, that's a lot of risk in one market, right? It's a tough one. If it can be boom or bust, right? There was markets previously in Alberta, brands that were exposed to the big run on oil. Well, when during boom time it was amazing, but then when oil went down, sub $50 a barrel, those stores got destroyed. It was it was awful. So we're fortunate that diversified on real estate and diversified on cuisine offerings. So we're a little bit lucky on that.
got me thinking which one it is now that it's in LA. I'm thinking, all right, plant based. Maybe it's. Should I say what I think it is? Make it get? No. Do you want me to? I won't. I was thinking maybe it's creation. Maybe nah. Maybe
No, it wasn't creations.
it wasn't creation. All right, cool.
No.
I like creation. That
Yeah.
pretty legit. Cool.
Yep.
All right. So look, you're answering most of my questions. I only got a couple more for you. So you kind of
Yeah, no.
answered. I mean, you pretty much answered already about what the company's path to profitability is, while still focused on growth.
Yeah,
Anything,
just
anything
open
you want
more
to add
stores.
to that?
No, the only thing people say, what do you need to do? What do you need to do? Just open more stores. And
Okay.
the good news is, like, we've Q2 was a record for us. We opened 12, and I've publicly said it. Like Q4, we're trying to challenge that record. So, like, there was previous times where we opened one in the quarter. Well, Q2, like, we're delivering like multiple hundreds of percent of organic growth. So Q4 is going to be a challenge for us, to challenging our previous record of number of openings in Q4. Q1, we've already got a ton of leases that we've announced and signed in 2026. And because our stores are usually signed 3 to 18 months in advance, we have a very predictable pipeline for growth. So we have predictable restaurant growth in 25 and already in 26. So I think we're one of the few, like, predictable based on contracts, and because we're a high margin business with royalties, we're asset light for the most part of the business. We have predictable growth into 25 and 26. So the number one thing that makes us tough is patience, because it takes time to actually build the business. So nothing else to do other than be patient, stay focused, and open successful restaurants. And for the next 18 months, we're going to open a lot of restaurants, and we're going to, I believe, deliver that profitability and numbers that our shareholders have been waiting for.
Absolutely. Another question that I'm sure you get asked all the time, and it's all about shareholder alignment. Just doing a quick search on insider ownership. I think, correct me if I'm wrong, it's a little over 6%, something like that. I think you.
Today we're total insider ownership. When I joined, was a sub 2%.
Yeah.
Today we're at 24.5%.
24.5%. Oh,
Yeah.
sorry.
We've been buying the stock and ourselves and increasing our positions. And one thing I did when I joined, we were trading at about 15 cents. We issued 27 million performance warrants, and to earn those, we had to go hit 50 cents, 75 cents, dollar, $1.50, and $2 by June of 26. So to get the large tranches of $1.50 and $2, By June of 26th, the share price has to trade over $2. And on top of that, there's about $6 million of money that insiders have to write into Treasury by June of 26. So we haven't taken any free stock, nothing. Everything's been paid for out of our own pockets. And so we have a chance to get the insider ownership to 35% going into next year. Once we'd have to write millions into Treasury from insiders. So we look to increase insider ownership. But to do that, to have the rights to buy them, we had to get to $2. And I'll tell you, when we were trading at 15 cents and then we went to 8 cents, and I knew my entire pay package was tied to $2. I literally felt like I was going to need a mining helmet back then. I was in the mining business, not the restaurant business, because it felt like I was literally looking up at like Mount Everest, right? Like it was going to be a tough climb, and it's been a grind, but business is accelerating, and we're in a very healthy financial situation. So execution for the next from now till June 26th. You can certainly assume that our entire team is focused on getting the $2 and having the right to buy them, and then putting that money into Treasury. So we'll be even, we'll have way more money in the bank, and it'll come from insiders. So we have very much alignment and our team. So, and everybody in the team, in the company, is tied to the $2 mark for full comp package.
Very good. And apologies, I guess my numbers were a little off there. But so to close this out here, and again, thank you for answering all my questions here. But from what you can tell us, and you kind of already said, you've said like 4 times, you want to be 100 million revenues, 100 million Canadian or US?
Yeah. I wish it was 100 million US, but 100 million Canadian and on run rate in early 26 is what we plan to be.
Gotcha. So in your opinion, where would you like to see this company in even 3 to 5 years from now? What do you think will be some of the inflection points to get you there?
If I had my way, we'd be and I think the potential of the business is $1 billion a year. And I believe at that point in time, you produce 30 to 50 million a year in free cash flow, and you're debt free. I think you can return a lot of that money to shareholders through dividends and through share buybacks. So I'd like to be known at that point in time as $1 billion a year business with a disciplined approach to the P&L and profitable, debt free. That would make me very happy and think I did pretty well for our team and our shareholders. We returned and we're respectful. So that would be what would I like to be known for down the road. That's that. And if we could build it to $1 billion from $1 million, that'd be a pretty incredible story. I think to tell the grandkids someday.
100%. Well, Sean, you answered all my questions. I really do appreciate it. Where can our audience go and find more information to follow along the Happy Belly story? A
couple things. A lot of people do follow myself either on LinkedIn under Sean Black, SEAN BLACK. A lot of people follow me on X under Extreme, the word Extreme SB for Sean Black. My old company was called Extreme Brands, so that handle stayed with me. Obviously on online, under HBFG and then HBFGF for the US side. That's where you can find us. And I think as you see us move into 26, don't expect anything crazy, just more disciplined growth, quarter over quarter, year over year. Just be known as a disciplined growth company that can compound earnings.
Very good. Well, Sean, thank you so much for joining me today. Really do appreciate it. Good luck. Stay safe. And I look forward to the next update.
Thank you very much.